First, to Jennifer on the internal competition, and that is definitely something, whether there'll be incentives to move costs or reduce costs in certain jurisdictions, and that is definitely something we need to give more thought to. The underlying principle is that if you are assigning routine returns to the functions and activities, then while those incentives are there, they're fairly muted, because if you say reduce costs by 10 in Ireland, you will shift, say, one of profit to a higher tax jurisdiction. And so while that would lessen the impact of reducing the cost from a company-wide perspective, it wouldn't be like it is today when we're doing my Dempy analysis, where if you move 8 executives who together make $2 million, you can save $400 million of taxes, And so it would definitely be a muting compared to kind of some of the extreme examples that we worry about today, although not completely. The other thing that I would appreciate your sense of is, many clients don't even pay attention for management purposes to legal entity accounting much, and they do product line accounting, and then assign taxes within the product line accounting. So for them, this system would actually work pretty well, because you would end up just kind of marking up the costs as you go along, and then you would have the residual profit that would dump into the market jurisdictions. And I would hope it wouldn't change incentives, internal incentives, all that much.
Well, it depends, yeah, if you do a pure product line versus is it a business unit, is an aggregate, geographic segment where,
right.
It's not just, typically not one country. And so you can see that is in the financial reporting, there's required segment information that companies have to provide. And what's in it is they have the choice as to whether to report by geographic segment or business unit segment. They're almost always business unit, which is not product line necessarily.
No, that's right.
And so that's
but they probably keep the financial statements for management purposes in a more specific way, don't you think?
But if it's multiple products within, you sort of overlay. That was the question. And so it was interesting. That's one thing I had highlighted in here. In the proposal, if you read it, they have an awful lot assuming that this type of record keeping is given or provided. Right. And, I know that was one of the big criticisms of the country-by-country reporting initially, was sort of getting their tax systems are very different than what their financial reporting systems are, right? And this seems to say we want a financial reporting system, but that's going to give us this geographic basis information.
Right.
And it should be there, but I think it's probably some cost to get.
A couple of things to Steve. Transfer pricing works much better if you're the UK than the US today, because the UK has a 10% patent box rate, a corporate rate that's presumably coming down to 15%, and a lot of Dempy activities going on in it. And now you have all of OECD agreeing that those activities get an outsized return. And so that is, I can appreciate why the problems with arm's length pricing from a UK perspective are different than they are from our perspective, and admittedly I may be tainted into overemphasizing them because of what I've seen over the past 30 years in the United States in terms of the movement of function and activities in response to tax incentives. But I think hopefully over the next medium period of time we can get a proposal like this to the point where people are interested in it and will observe what's going on in the post-BEPS world out there in terms of whether transfer pricing is working. And my bet is that it will get worse rather than better. And so something like this would be more useful to put on the table. The other point is that in saying the value is in the product and we're shifting it to the market, to me, it's just not that simple. I mean, you can look at anything like an iPhone, where the technology in an iPhone, and Apple will argue this up and down when they're arguing about the value of their technology in any transfer pricing case, and they're largely right, is not that huge relative to the value of the technology in anybody else's iPhone, including imitations. And so much of it is in the consumer. The premium value is in the consumer perception in a product like that. And that's true with so many consumer products. And to say that that means the value is in the product is kind of putting the rabbit in the hat to me, because the value is in something much broader than that. And then you take something that's completely different than that, like the pharmaceutical products that are protected by patent. Again, yes, we were involved in the same case Steve was involved in. That was the biggest transfer pricing case in the United States involving Glaxo. And yes, it's true that it was the discovery that was really the key to all of that value, but it also was the protection of it, the monopoly position that allowed the realization of that value. And it's not clear to me that that means all that value should be back in the jurisdiction where the development took place, as opposed to the jurisdiction where the protection takes place. So it seems to me it's much more of an ambiguous a construct in terms of where is value created. And when you add to that the mobility factor, if we are correct that the market is the least mobile factor, then it seems to me you can get fairly comfortable with that as being the jurisdiction of residual profits.
Although if we were doing an M&A deal where we went back to the client and said, by the way, we've got all the distribution, but we ain't got the IP, I think we might have a rather disappointing client at the end of the day. And no, I agree with you. I think on the marketing intangible side, there's clear value in brands. There's clear value in creating the knowledge about that brand in a market. Do you think I'm being too cynical in saying that the US there's a bit of benign neglect about the man in the deck chair, or not? Because I just...
No, I think the man in the deck chair in Bermuda is more a function of the willingness of jurisdictions like Ireland and Luxembourg and Switzerland and the Netherlands and Singapore, in their own cases where it's not Bermuda, you can stay in Singapore, to give up their taxing jurisdiction. Because, sure, our Subpart F rules don't pick it up when you have IP in Bermuda that's licensed into Ireland. But it's really Ireland that is allowing that to happen and not taxing it at a 12.5% rate. I mean, 10 years ago, Ireland didn't allow that to happen, and they decided they needed to because they couldn't compete with Singapore and Puerto Rico. And Switzerland and Luxembourg. And so it was the tax competition within the tax haven community that has allowed that, not anything in U.S. law. Sure, our Subpart F rules meant that U.S. companies could benefit from it, but that's not the cause of it, to my mind. And that's why the state aid cases, state aid cases shouldn't be retroactive, but why the ability of, if there's a problem, it's the problem of countries willingly giving up their tax jurisdiction over their stated rates in order to attract investment.
Thank you. Now, Mick has a short remark, and then I go to Steve Shea.
Thanks. I'll be very brief. It's nervous being stuck between lawyers and an accountant. I think as an economist, I hear a debate about values in the product or in the market. For an economist, this kind of doesn't make any sense at all, I must say. But I won't go into that. But I'll stick to something economists maybe can say stuff about. But it's kind of symptomatic, I think, of a difficulty that economists have in this area. I think it's difficult to put our brains around these things. Just on the incentives to join issue, that is clearly an important one. What are the incentives for countries to participate in this scheme? I think all I'd say is this is clearly something we need to think about, but I don't think we should assume they wouldn't have an incentive to join. You can imagine circumstances where actually this would be an attractive scheme for countries to join. So I would just want to put that down as to be thought about, rather than necessarily it's not clear countries would want to join. I think the efficiency issue discussed, as far as I understand it, also relates to some of the points I was making about actually figuring out how, what this does to production decisions, what it does to what economists would call production efficiency within the firm. But I did just want also to pick up, just finally, to mention something on developing countries again. Also, somewhat gratuitously, to pick up a little bit on something Reuven said earlier on. I think, we have to recognize that these issues are important for developing countries. They may be not so many billions, but some of the work we've done for developing countries says, there's a 1% of GDP potentially. I'm not saying they're going to get it back, but 1% of GDP in a low-income country may not be much in dollars, but it's actually, when the tax revenue may be 10-15% of GDP, this is a big chunk of money. And I think we can say on the transfer pricing is not broken. Clearly, I think that's clearly it clearly is broken, I think, for many developing countries. And I think even the BEPS project, one of the things we're doing is working on these toolkits with the fund, with the OECD and Bank and the UN, which is really about taking on some of the particular issues for developing countries. But sorry, that was somewhat gratuitous in terms of the topic. But, oh, sorry. I'll leave it.
Thank you. Steve.
I just want to congratulate the project because there are two things that Paul has identified. If I think of the proposal as having three major pieces: permanent establishment without physical presence, allocation of expenses, and third, allocation of residual profit. What BEPS has not done and what has to be dealt with is the remote seller issue, the permanent establishment without physical presence. We've got to start wrapping our minds around that, because without that, there's no real future in the world that we're living in. Second, one of the biggest problems with structurally today under our existing system is the failure to fully allocate expenses. Data from a number of years ago that I was looking at showed that for US companies' allocation under our own bizarre allocation rules, G&A was larger than interest. Interest was second, R&D was third, but artificially low because someone up on the panel did a superb job years ago lobbying the Treasury when somebody speaking was in the Treasury against
Thank you, Steve.
allocating too much R&D.
My business card is right here.
So on one thing that happens with lobbyists, so now I'm going to switch places, Paul, is we like to cherry pick. And so in response to Stephen Edge's comment, we should or could think about picking up the PE piece and the expense allocation piece, and having a PE, a remote PE, but requiring that PE to take the allocation of expense. That has very positive, coming back to the incentive compatibility aspect of this. That would have positive outcomes in tax havens. You could have a PE there, they would have to take the expense. That means the selling MNC would lose the value of the expense in the high tax jurisdiction, pick it up in the low tax jurisdiction. And just generally, we should be allocating the expenses, the indirect expenses, to where the income is ultimately earned. So I think that alone would be an improvement, even if we didn't get all the way to the allocation of the residual income. So just food for thought.
Paul, do you want to react to that?
No, I find myself in the unusual position of agreeing with Steve.
Thank you. Additional? Yeah, please.
Hi there. Hello. It's on. I think from the point of view of investors, this is a really good approach because it's actually more transparent. And I would, if I want to put this proposal forward, I would seek basically the investor community rather than directly at the companies themselves, because I can see with my Machiavellian hat on, internally in a corporate, this would to some extent reduce flexibility within the management process. So I would focus on investors, and I would pick up on what Jennifer mentioned with Warren Buffett. You know, in the long run, it should add transparency and add overall to investor selection. And another point to think about would be in emerging market countries, say, let's say a country like Nigeria, obviously one concern if you want to sell into Nigeria a product or a service is that, yeah, they can turn around tomorrow and put exchange controls down. So there are arguments to, if you like, misallocate costs, because one is always worried that, you know, payments coming back, and in having something very transparent, of course, their local fisc could then say, please show me this dollar payment I have to send back, and tax accordingly.
Thank you. I think we have time for one more remark from the audience. If that is not the case, oh yes, Michael?
I too would like to congratulate the members of this panel and the previous one. My question is I can see the attraction of attributing tax consequences to where your market is, where your customers are situated, particularly if your customers happen to be retail customers, because they are obviously relatively immobile. If your customers happen to be businesses, though, they're not necessarily so immobile, because they might set up a purchasing subsidiary or purchasing branch in a tax haven somewhere, and I'm trying to get my head around how your system might apply to...
Yeah, that, and I wasn't very clear about that in the presentation. That's why we were saying if you are operating through distributors, then you need for the distributors to tell you where the goods are being sold down to the retail level. But your problem is a real one where the sales are not of finished products through a distribution chain, but where they are of intermediate products and capital goods into a business. So the example of Intel selling chips to Hewlett-Packard, and I really do think more work. Harry Gruppert in the United States Treasury has commented on this, that he worries that factor mobility could be pretty substantial with respect to the purchasers of business components and capital equipment and where they put their factories. If in fact a system like this could lead to lower pricing from their suppliers, if their factory is in Singapore rather than in Palo Alto, and we just haven't done enough work to figure out try to get a handle on the magnitude of whether that could happen. I would say in a residual profit system, unlike a sales-based apportionment system, where the residual profit is likely to fluctuate over time, there'd probably, at a minimum, there'd be less certainty about the advantage to an Intel in selling to HP in Singapore versus Palo Alto, and therefore they might be less likely to build it into their pricing than they would with something like formulary apportionment, where they might be able to more ably predict the how much tax reduction they would benefit from, and therefore how much they would be willing to share that with their purchaser.
And the practical mechanics of that, Paul, would be quite difficult, wouldn't they? So the advantage of PEs is you've got somebody on the ground who you can then tax, even with a dependent agent PE. If actually what you've got is somebody selling into a jurisdiction where you've got an independent distributor who is charging through the nose for the work they're doing and capturing, therefore, they think the full value generated in that jurisdiction, to the extent you've then got incremental tax, first of all, that's showing that there is additional tax being generated over and above the activity in that jurisdiction, which is an additional marketing intangible, as it were.
That's right.
And then secondly, you've got to decide who's going to pay it. Especially
well, yeah,
if
you would probably end up having some sort of withholding tax mechanism that if the seller to the distributor didn't volunteer to pay the tax on a net basis, then there would have to be some sort of withholding certificate mechanism from the distributor to basically make sure that the seller pays local tax. I mean, we see that in other areas of the law now, and that would probably have to apply in that case. That's a problem with all of these kinds of proposals that are taxing in the jurisdiction of the consumer profits that are not attributable to whatever entity has a physical presence there. We're going to have to deal with that in all of these proposals. It's not peculiar to this one.
Thank you, Paul. Just two concluding remarks from my side. First of all, we are pretty confident that all this is in line with WTO law, because it does not include any border adjustment. There is along the production line no discrimination against foreign products, because it's basically only about the same old profit which has been around for many decades, just to be allocated in a different way. And the second bit will be interesting to learn when it comes to transitional periods, incentive compatibility. Like 10 years from now, a Chinese treaty negotiator and a German treaty negotiator sitting together, having agreed on the allocation of the routine returns, and then discussing where the residual should go. And the decisive question will be whether both of them, looking at their trade balances, they will say it's in the best interest of both of us to go for a market country allocation of the residual. If that does not happen, then there will be a problem. But I think there are good reasons to consider this to be a possible outcome.